Good afternoon, everyone. Welcome to the Edgemoor Investment Advisors Mid-Year Market Review and Outlook. I'm Jordan Smythe. I'm here today with my colleague, Gay Truscott, and we really appreciate having so many of you join us for the next roughly 30 minutes, during which we'll share some thoughts and observations with you and also answer your questions. I'll just briefly review our agenda here today. We'll start by reviewing current economic conditions, including both positive factors that are supporting the markets and the economy, and also some challenges that we see to the continuation of the long bull market in stocks. I will then share our thoughts on the stock market's current valuation, and Gay will conclude our remarks with our outlook for the coming months and a few specific examples of the opportunities we're finding today. We'll spend about 10 minutes at the end of our session answering your questions. Thanks to those of you who have already submitted questions when you registered, and anyone else who would like to ask a question during this session can do so at any time by clicking on the Q&A link, which you should be able to see if you move your mouse to the bottom of your screen. There's a Q&A little icon down there, and if you click on that, you'll be able to type in a question that we will see, and we will just submit those at any time, and we'll answer as many as we can at the end of our remarks. The first nearly 7 months of 2019 have been fantastic for stocks. In fact, the almost 19% return of the S&P 500 index through the end of June was the best first half for the stock market since 1997. And the market has added to these gains so far in the third quarter, which we're about a third of the way through now as we approach the end of July. Overall, we expect the good news to continue to outweigh the bad, but would not be surprised to see stocks take a bit of a breather at some point or even pull back. Gay will now start our discussion by reviewing some of the positive forces in the markets today.
Thank you, Jordan. I'd like to start by reviewing what we see as major strengths in the market today. Remembering, of course, that despite all the headline risks we seem to face every day, it is these fundamentals of our economy that primarily drive the stock market over the long term. There are four major economic indicators that we will discuss today: unemployment, wages, interest rates, and consumer confidence. Together, they are part of the backbone of our economy and some of the primary drivers of economic growth. So let's begin with unemployment. On this slide, you see that the unemployment rate in June dipped down to 3.7%, which is near a 50-year low and is the lowest rate so far in the 10-year post-recession era. As the job market has tightened, the other good news here is that wages have begun to rise as employers are forced to pay more for the workers they need. As an example, specifically in July, wage growth accelerated to an annual rate of 4%, with gains really across the board of almost all the sectors, but led by manufacturing, construction, and services, all of which were up over 4%. Interest rates, which you see on this familiar slide, remain at historic low rates. As we wrote in our quarterly newsletter, all eyes are on the Federal Reserve this week as it conducts its open market committee meeting, which concludes tomorrow. And all expectations are that the Fed will announce a rate cut to its Fed funds rate by 0.25%. And this is after a pretty steady stream of rate increases over the last several years, including 4 in 2018 alone. So a reversal now will be significant, and it will mark the first interest rate cut by the Fed since 2008 during the depths of the financial crisis. So this expected action is driven really by combined concerns of slowing global growth and trade tensions with persistently low inflation in the U.S. Now, whether this begins a new series of rate cuts is really unknown, though the markets are already betting on more cuts this year and perhaps into next year. We're not so sure, and we will wait to see what Chairman Powell says tomorrow before speculating on the direction and the duration of rates. Another important economic indicator is the consumer, because that's really who drives our economy. This slide shows the University of Michigan Consumer Sentiment Index, which was up nicely in July, continuing a positive trend that we have seen for most of this year. In addition, growth in consumer spending, which accounts for 70% of the U.S. economy, rose sharply in the second quarter to 4.3%, compared to just 0.8% in the first quarter. This was the strongest quarterly gain since 2016, and it also stands in pretty sharp contrast to business spending, which declined in the second quarter. And moving to a snapshot of the markets so far this year, as Jordan talked about at the outset, we see how the markets have reacted to a lot of these strong economic fundamentals, with the S&P index of U.S. stocks leading the way, up almost 22% year to date, compared to 13.8% for foreign stocks, that middle line, and a surprisingly strong 6.5% return for the U.S. bond market. So clearly investors like what they're seeing so far this year. Now I will pass it back to Jordan to talk about some of the challenges we see in the market today.
The trade war we're having with China and other nations is, in our opinion, the biggest threat to the global economy and the markets that we currently see. There's already been a sharp slowdown in global trade as a result of tariffs and other actions. As you can see at the right end of this chart of global trade growth rates since 2000. You can see that sharp drop off at the end of the chart. Global supply chains are shifting as companies try to find sources outside of China, and uncertainty makes planning for long-term investment difficult for businesses. A U.S. delegation is in China as we speak for another round of talks, and we're optimistic and hopeful that there will be some progress there. There are a few specific things we might expect to see. One is that the U.S. will likely back down from some of its restrictions on companies' abilities to do business with the Chinese tech giant Huawei, something that the administration has already floated in the last few weeks. And we also think the U.S. will continue to insist that China strengthen its protections of intellectual property, which is really one of the core issues in this dispute. Slowing global trade is a major factor that is causing global economic growth to slow. Forecasts are for lower growth in developing countries around the world over the coming years compared to what we've recently seen. And emerging markets, which typically have higher growth rates than developed markets, will continue to have higher economic growth, but the rate is slowing in those countries also. The best example there is China, where GDP slowed to a growth rate of 6.2% for the second quarter. 6.2% is still relatively high compared to the rest of the world, but that's well below the average of 9.5% for the past 3 decades. Here at home, GDP growth has been higher than in much of the developed world, but it's still slowing. The second quarter GDP came in at 2.1%, below the 3.1% that we saw in the first quarter. And we think this drop from 3.1 to 2.1% was due to the negative impact of the trade wars, which seem to be offsetting the stimulus from last year's corporate tax cuts, and also from the decreased business spending, which has offset the increase in consumer spending, both of which Gay just mentioned. U.S. GDP growth for the full year and beyond 2019 is likely to be in the closer to the 2% range than the 3% that we've been seeing for the last year or so. Slowing economic growth and other impacts of the trade wars are reflected in corporate earnings this year. As we've noted in many of our newsletters over the years, corporate earnings are really the foundation for the market, and stocks are unlikely to continue their strong run without support from earnings growth. However, earnings growth is stagnating. This first chart shows the earnings per share estimates for the S&P 500 index, and the next chart shows the percentage change you can see the big bump in earnings that we got in 2018, up 21%, largely due to the effect of the corporate tax cuts. And then growth dropped dramatically. The estimates have dropped dramatically for this year, down to 1.7% currently for the full year, which assumes the pickup in earnings in the second half that analysts are currently expecting. This 11% estimate for 2020 may prove to be a bit optimistic. We'll see, but maybe optimistic given the prospects for economic growth, and we would expect that rate to probably drop, as is often happens as the year progresses. Very interestingly, there's a stark difference between the earnings growth that we're seeing in the second quarter for companies who are operating primarily domestically and those operating abroad. And this next chart highlights this big difference. The overall forecasted drop in earnings for the second quarter is a drop of 2.6%. This drop of 13.6% in this green column represents the earnings drop for companies that have half or more of their revenues coming from abroad. And that's very, very different from what we're seeing from companies who have more than half of their revenues coming from the United States. Those companies are seeing a 3.2% rise. So this difference is once again a reflection of the trade wars, and specifically the impact of the impact of the trade wars. In addition, what we're seeing is that profit margins have declined for these global companies as well, and that's a specific indication of the impact of tariffs on these companies who must import materials and products that they use in inputs to their manufacturing processes. There's just a big difference for companies focused domestically and abroad as a result of all the trade disputes going on. I want to provide a brief overview and explanation of a yield curve inversion, which is a term that's been in the news recently. This chart shows the Treasury yield spread, or the difference between the yield on the 10-year Treasury and 3-month Treasuries over time. 10-year Treasury representing long-term rates, 3-month representing short-term rates. Usually the economy is expanding and long-term interest rates are higher than short-term. Anytime any place you see on this chart where the green line is above this horizontal axis, that's a period during which the yield spread is positive, long-term rates are higher than short-term, and the economy in most of those cases is expanding. However, concerns about near-term economic weakness and future growth prospects can sometimes result in short-term rates rising above long-term rates, a situation called a yield curve inversion. And that's represented on this chart by any period during which the green line drops below the axis, as you can see here in several places. Inversions have preceded many U.S. recessions. Once again on the chart, the areas with the gray columns are periods during which we had a recession, and before each of these you can see the yield curve inversion. A couple of things to note though. One is that an inversion needs to last for a while, usually several months, before it becomes an accurate predictor of recession. And also there's a delay typically between inversion and recession. It's usually about a year to 18 months. We are currently experiencing a yield inversion, as you can see at this point on the chart. But despite that, we believe there's little risk of recession this calendar year. The primary reasons we believe that are that economic conditions are still relatively strong, and also many economists believe that the normal relationship between short and long-term interest rates is currently distorted because the Fed has been raising short-term rates for several years, and lower or even negative yields on other nations' debt have put pressure on U.S. long-term rates. Nevertheless, while we're fairly comfortable that we're not going to see a recession in 2019, we're less certain about 2020 and beyond. And right now, the Federal Reserve Bank of New York calculates the likelihood of recession in the next 12 months at about 33%. Now let's turn to valuations in the stock market currently. As I mentioned previously, growth in earnings is a critical factor that leads to the rise of the stock market over time. The price earnings ratio, or PE, is another important factor. The definition of PE, price earnings ratio, is the current price, in this case of the S&P 500 index, over the projected earnings for the next 12 months. PE indicates how much investors are willing to pay for each dollar of earnings, and it's the most common measure of market valuation. This chart shows the history of the PE since 1994. And as you can see at the end of the chart, the current PE multiple is right around 17 times. This chart actually cuts off at June 30th, and the current multiple was just a tad higher at 17 times, which is just above its long-term average of about 16 times, represented by this green dashed line. Now let's put this current PE of 17 into a bit of context. A high PE indicates investors' willingness to pay more per dollar of earnings, and that can be a sign of an overheated market. A good example that we can see on this chart, one of the best ever really, is what was going on at the height of the tech boom, approaching 2000, when the PE multiple reached a peak of somewhere in the mid-20s. Following that peak in the PE ratio, returns in the stock market were not very good. Conversely, you can see the trough here, this bottom in March of 2009, where the PE ratio dipped to as low as 9 times earnings. And the market has since that very low PE, the market has more than quadrupled in price. As I said, the PE is now around 17, just above its long-term average, and based on this measure, we consider the broad market to be trading close to its fair value. This is particularly the case when taking extremely low interest rates into account, which provide a justification for a PE that's a little bit above the market average, still being attractive. Low rates support economic growth, and they also make stocks more attractive relative to bonds. Keep in mind that we invest in a small subset of stocks that we do believe are all considerably undervalued, and we'll give you a few examples in just a few minutes. I'll now turn the presentation back over to Gay, who will discuss our outlook and some of the opportunities we see.
Thanks, Jordan. Yes, we've talked about a lot of facts and figures here today, so let me summarize for everyone our outlook for the remainder of 2019. First, we do not foresee a recession this year. We do, however, expect corporate earnings to grow, albeit at a slower rate. We do expect the Fed to cut interest rates, but how low and for how long at this point is unclear. Global growth will continue to slow, but at different rates around the world. We are hopeful that trade and tariff issues will be resolved because in the third year of the current administration, there should be every incentive to stimulate growth ahead of the 2020 election. And finally, we are cautiously optimistic that stocks can hold their gains, though certainly threats remain. So turning to opportunities, in the context of a market that is in the range of full value, active management, like what we do at Edgemoor, has the opportunity to uncover hidden value, particularly in purchasing individual securities like we do for our client accounts. In addition, as always, diversification and asset allocation of client portfolios is as important as ever. So as we look for opportunities, let's take a moment to review the key investment criteria that we employ really through all market conditions. It includes looking for companies with low valuations as measured by price to earnings and price to book value, excellent prospects for growth, companies with a strong franchise or economic moat, which you often hear us refer to, and that is the competitive advantages that protect a company's market share and profits. We look for consistent, positive free cash flow and high returns on equity and invested capital. And finally, a strong, qualified management team that is shareholder friendly. So this next slide shows specific examples of where we are finding value in this market. It lists 6 companies whose stocks we are currently buying, with several new additions this year, just this year, to our buy list: Bank of America, Bristol Myers Squibb, CVS, and Delta Airlines. The slide shows each of these companies with several important metrics: forward PE ratio, dividend yield, and 5-year forecasted earnings per share growth rate. You will see that many of them, the first 4 specifically, traded a significant discount to the overall market price earnings ratio that Jordan just reviewed of 17 times forward earnings. The next one down, General Dynamics, trades basically right in line with the market. And Microsoft, which is one of our longest and best performing holdings, trades at a premium, but which we think is justified given its strong growth prospects. In the middle column, you can see that they all pay attractive dividends, many of which are growing, and most of which are above the average dividend yield for the S&P 500, which is just above 2%. And then in the far column, again, they all exhibit good 5-year growth prospects. So these are all examples of good, solid companies that we believe represent really good value for investors today. And so we are buying them in the market currently. So in conclusion, we've reviewed many of the strengths, but also some of the challenges we see in the market today. On balance, we still see the positives outweighing the negatives. But we know that at some point there will be another bear market or correction of 20% or more. We just don't know exactly when. So our advice to investors is, as it has always been, even in 2008 during the Great Recession, to stay the course, be patient, and remain invested in the quality companies that you own, knowing that the market will recover from any downturn, likely stronger than ever. So now I will pass it back to Jordan for our Q&A session.
Thanks, Gay. We've now concluded our prepared presentation, and we'll turn to your questions. Just feel free to submit a question at any time by clicking on the Q&A button at the bottom of your screen. I will start with a question that one of you submitted when you registered. That is, how do you decide when to switch an investment? Where or how do you go about doing this research to make a decision? Well, we meet formally at least once a week as our investment selection committee here in our offices, and we review the holdings in our portfolio and discuss whether we want to make any changes. And those changes could be deciding to sell a position, deciding to change the weighting of a position in the portfolio, potentially adding a new idea to our the list of securities that we're buying, the question seems to imply switching investment, maybe imply a sale of a security, and the decision to sell would result from our having that discussion and deciding that the current price of a security that we own is higher than what we believe to be the intrinsic value or the fair value of that security. That's our best estimation of what we think the company is worth based on our evaluation of the fundamentals, and that could lead to a sell decision. The sources of information, how we go about this research would be looking at public filings, looking at other research reports available to us, other information, and we just take as much data as we can and conduct our own research and our templates and have a good, robust discussion and decide what to do. And I'll just finally just mention that one of our relatively recent decisions to switch an investment was to sell Southwest Airlines, which we'd owned for a while and had done very well, but we felt like was trading relatively high relative to its intrinsic value, and we swapped that for Delta Airlines. Coincidentally, or at the same time we were doing that, it was the beginnings of the issues with Boeing 737 MAX. And Delta, one of the advantages of going to Delta was that Delta uses none of those aircraft, so it's been relatively immune to the issues that others have faced. And finally, I just mentioned we do own Boeing as well, as you know, and that's a stock that we are keeping a close eye on and are sticking with for now. It happens to be up today, which is nice to see, and we'll continue to monitor that and see whether we need to make any changes there. We have another question. Gay, I'll pass this to you. How do you feel about the growing deficits?
Well, that's a great question, and it's one that we think about a lot. We do think federal deficits are an important kind of structural piece of the economy. And in the long term, federal deficits can significantly dampen economic growth and even lead to recession. So it is something that we watch closely and are concerned about kind of over the long term rather than kind of the near term. But again, it is a very important structural piece of our economy and is cause for long-term concern when we see significant upticks in deficits.
We have a question here about gold. How do you feel about buying gold in times when it may look like the economy is slowing? We have we've often discussed and of course follow what happens with the gold investments. There are many people who believe that gold is a good place to be during times of economic weakness. We are not among that group, however. We think that there are better investments to make. And that gold, really, the primary issue we have with gold is that it doesn't have any intrinsic value. It's not used in the industrial processes, for example. It doesn't do anything. It sits there, and it increases in value only if people decide that it just should. And we prefer to have productive assets that we can see a way to how they're going to generate value and earnings and dividends that would support higher prices. And in gold, that's our general view. Gold, for what it's worth, has not performed well relative to the stock market or other investments over time either. So we just don't agree with the notion that that's the place to go in times of economic weakness. We have a question here about the recession. You mentioned the possibility that there would be a recession. Does that mean that you would be making any specific changes to your portfolios? Okay.
Sure. I'll take that. Another question we often get. I think the first part of the answer is to remind everybody that we are not market timers, meaning that we do not make major moves in and out of the market, because it has been proven to be an unsuccessful strategy for investors. It's very inefficient tax-wise. And instead, we really do believe in staying invested in quality companies throughout market cycles. This was recently proved, we think pretty convincingly, in the last quarter of 2018 when the stock market dropped, I think it was like 19%. And so had you sold out in late December, you would have missed the quick recovery that we enjoyed through the first quarter of 2019 and continue to enjoy when stocks have rebounded more than 20%. But having said that, yes, we do make adjustments to portfolios. For example, we've been buying more short-term bond funds in the income portion of our clients' balanced portfolios. And this is to provide some ballast or stability against the potential volatility on the equity side. In addition, just the broad array of dividend income that we generate for clients also provides a very nice cushion against a downturn, a longer-term downturn in equities. So that's really how we position portfolios when we do see a risk for downside on the equity side.
Okay, we're running out of time here, but I'll quickly just answer one other question that came up, which has to do with the housing market. What are your views on the prospects for the housing market and recent performance there? We do believe that there is pent-up demand for housing in the United States that will need to be addressed over time. The housing market has sent some mixed signals recently about how strong it is or whether there are issues there. And despite the fact that mortgage rates are extremely low, the housing activity has been weaker than we would have expected in the near term. However, we still believe that over the long term, there is great demand for housing that's going to need to be filled, and we think the prospects are very good for the market in general, the sector in general, and also specifically for Lennar, which is our current holding in the housing sector. We would expect good returns from that company and from the sector as a whole. All right, well, it's a little past 4:30. We started a couple of minutes late, but are right at about 30 minutes now, and so at the end of our scheduled half hour with you today. So we will conclude this webinar. If we didn't get to your question, we'll follow up with you to answer it. Thank you again for attending. We really hope you enjoyed this presentation and also the webinar format, and we welcome any comments or suggestions you might have for future events. We hope to see or speak with you in the meantime, and we'll be back here in about 3 months for another quarterly update. Have a good evening.